Let's briefly consider the income statement. The income statement provides a measure of the performance of a firm over a specific financial period. The income statement is prepared using the accrual basis of accounting. This involves the accountant applying the accrual concept to try and capture an objective economic representation of how the firm has performed in substance, if such a thing is possible. The accountant does this by applying the accrual concept to accelerate and defer revenue and expense items through the income statement. The order of the items in the income statement is not arbitrary. The logical flow and the order of the items tell us important information on how the company has generated its profit and how that profit has been distributed amongst the various claim holders. At the top of the income statement, there is an explanation of the gross profit of the firm. The gross profit equals the sales revenues less the direct costs to generate those revenues. The next section of the income statement explains the operating profit of the firm. This is equal to the firm's gross profit less other, more indirect operating costs. The operating profit is a measure of the profit that has been generated by the firm that is available to be distributed to all claim holders. Various claim holders are then assigned their share of the operating profit. The remaining section of the income statement explains how the operating profit is distributed amongst the various claim holders. The taxman will take a share of operating profit in line with tax legislation. The debt providers will take their fixed share of operating profit in line with the debt agreements. Finally, whatever profit is left behind after the taxman and debt providers have taken their share belongs to the ultimate owners of the company, the shareholders, who have a residual interest in the profit. So the order of the items in the income statement is important. It tells us how the company has generated its profit and how that profit has been distributed to the various claim holders. The top line of the income statement measures sales revenues. The next line measures the direct costs necessary to generate those revenues, otherwise known as cost of sales. Sales revenue less cost of sales measures the gross profit of the firm. If we subtract off other, more indirect operating expenses from gross profit, we arrive at the firm's operating profit. This midpoint on the income statement, operating profit, is a measure of the profit that has been generated by the firm that is available to be distributed to the various claim holders. The remaining section of the income statement details how that operating profit has been distributed to the various claim holders. The debt providers will take their fixed share of operating profit next. This is reflected by the interest expense or finance costs line on the income statement. Next, the taxman takes their share of the operating profit in line with tax rules. Finally, whatever profit after tax is left behind, the bottom line of the income statement, belongs to the ultimate owners or shareholders in the company. They have a residual interest in the profit of the firm.